Check, 1, 2, all right. Firstly, welcome back everyone. I hope you all had a refreshing break. I hope all of you enjoyed the snacks, the samosas, the tea, coffee, yes? It was a much needed break as well. There were a lot of insights coming in from this side of the hall, and then we also managed to have our own set of conversations with one another. So I hope all of you are making the most of it in terms of connecting with our speakers as well as our sort of peer members of the audience. With that, without any further delay, what we've decided to do is have a feisty round of a fireside chat coming your way. I'm going to request all the members of the audience, everyone, to very quickly take your seats. Now, this particular fireside chat, this is where we're going to find out more about how new age digital banks are strengthening their systems and also creating customized offering to serve the customers. That being said, we have with us none other than Mr. Anubrata Viswas, who's the Managing Director and CEO, Airtel Payments Bank. And spearheading this conversation, we have with us none other than Shalil Gupta, Business Head, Mint and Mosaic Digital. So while I'm going to invite Shalil on stage, I believe you will be setting the tone for the fireside chat. If we all enjoy the samosas, can we have an energetic round of applause? And let's also welcome Mr. Anubrata Viswas. Thank you so much for joining in.
There's only one good evening I could hear actually. Let's try once again. Good evening, everybody. I think the right-hand side was very good. Left-hand side still having coffee, tea, samosa, vada pav. Let's try last time, guys. Good evening, everybody. Welcome back. Thank you very much. Thank you very much. I think it's a very interesting topic, guys, right? And I don't know, sometimes I always wonder, why do we call it a fireside chat? Why not an iceberg chat, right? But nevertheless, we are continuing with whether iceberg or a fireside chat. The topic itself is very interesting. I think it's almost now about 7-8 years we have been hearing about neobank, digital banks, digital infrastructure, and all of that. In between we had, demonetization and then acceleration through pandemic and so and so. So I think things have changed largely. I think our discussion would be continuing, but I would also say if any questions at your end, please raise your hand. My colleagues will bring a mic to you and we can ask the question. But Anubrata, thank you very much for joining us today. I think we have seen in last so many discussions, we have been talking about how banking ecosystem has been evolving. In fact, India is a country which has largest fintech adoption from a global perspective. It's almost 87%. And in fact, what we are also seeing that India will surpass global perspective as well from a fintech emergence perspective. So we are now looking at, in the banking scenario, all the value chain, coming out from a fintech perspective. Now, this started with the payment banks becoming more important for us. And I think, Airtel is one of them which got the payment bank's license. But my question is more doing a macro analysis. What is the difference between sort of big banks, neo banks, digital banks, and how are they relevant to context of India? I think that's still hazy picture in everybody's mind. So why don't you start with that?
So Shalil, firstly, thank you for inviting me. We can call it a samosa chat, actually. That's probably the best thing rather than a fireside.
So next time onwards, we'll put some samosas background, right?
Absolutely. So I think, look, neobanking as a term has been coined from the West. It's flown very elegantly into India. But there's a very vital difference between neobanking and digital banking. Neobanking is what I would call an unregulated player, operating with a layer of experience, consuming licenses at the back.
Sure.
It could be licenses from a mutual fund company, from a bank, from an insurance house, and essentially selling a better sliver of customer experience at the front. A digital bank is actually a regulated licensed player. We've seen this globally emerge across various countries. There are broadly 250 digital banks in the world. APAC would have, give or take, 50. India is a little unique in the sense that India does not have a precise digital banking license, but I would argue that a license serves a purpose. And payment banks are India's new league of digital banks. What are the issues which one has to think a bit deeply about before concluding on the topic of this conversation, which is digital banks? The real issue between a neobank and a digital bank is sustainability. As a regulated entity, the first and foremost driver of sustainability is that you need a path to profits. For a neobank, you necessarily have slightly smaller revenue streams because you're consuming part of the manufactured product and therefore part of the revenue. And therefore, there are very few neobanks. In fact, I can't think of a single neobank which is profitable today. So this is the context of a neobank and a digital bank. And now let's look at India. Why digital banks? The first thing we, and at least at Airtel, we believe very strongly, is that there is a 500 million underserved opportunity in India. And let me break that down. There is a 300 million opportunity sitting in rural India where the average distance of a bank branch is 11 kilometers. There is a need for a banking service to come closer and hardwire and rewire financial services for this community or this set of people. The second big opportunity is that even with the growth of UPI, you've got roughly 200 million people in urban, metro tier 1, tier 2, who don't use digital financial services today for a wide variety of reasons. Put these two together, you have a 500 million opportunity. And therefore, the driver of a digital bank really is, what are the problems to solve? Can you offer services at a better proposition than a traditional bank? And what are those propositions? And I'm happy to talk through any of that as we go ahead in the conversation.
Absolutely. And I think you raised a sort of a voice there. When you talk about why digital and why a 500 million sort of potential opportunity for us. But more likely, if you look at it, there is an environment, an ecosystem which is very fragmented getting created. At one end, you have big banks, from SBI, public sector banks to private sector banks. Then there are international banks as well. Then you have payment banks, the licenses have been issued now. There are sort of Bandhans and you and others as well. Then you have ecosystem of fintech coming up, right? Now, this ecosystem is sort of confusing everybody now, whether I'm competing, whether I'm complementing, how do I work together? And it is moving, sorry, beyond 30 cities of the country. So Bharat and India is what I'm looking at it, connecting it together with the ecosystem. How do we decouple or we really solve this puzzle first?
Yeah, let me talk about it from our experience. Our experience starts and ends with the consumer. Why should he take a service which is different from the traditional service he's been consuming? And there are really two drivers. I'll talk a little bit about the global context of why people take direct banks and an example in India. See, in the world, direct banks have had a very simple proposition. You cut out branches, you are able to drop your costs to roughly 30 to 40% of a traditional operating cost model of a bank because branches are the single biggest cost driver. And you transfer that saving into a better valued product to the consumer. If you are able to therefore deliver convenience, which is a good experience, and you're able to deliver value, then you will have uptake. So some very well-known banks, which would be a Revolut in UK, one of the better business banking banks, which is Starling Bank, all of them have followed this simple proposition. In India, it's a little interesting because financial services has seen very intense competition over the last 10 to 15 years. While you've seen, I would say broadly, asset and liability growth in low teens across compounded over the last 15 years. Market share private banks have gone up now to anywhere between 25 to 30% of the banking system. So there's been very high competition. But I will argue and this is linked to the point you are making, I will argue that the banking industry is what the soap industry was in 1970s in India. Let me give you an example. In 1970s, you had Lifebuoy, which was the dominant soap, and it was used for washing clothes and bathing yourself. Wind up to today, you've got soaps for washing clothes, you've got soaps for very different need categories and for very different sets of consumers. So our thought process and our argument is that propositions, fundamental needs driving behavior will really splinter the market and allow consumers to choose and choose better. So let me now take this example and talk about direct banking in India. Our startling realization has been that while digital payments have grown manifold, people are really concerned about their money being safe. 57% of urban India, particularly tier 1 residents, believe that they do not want to expose their ICICI bank account or HDFC bank account to UPI because they are afraid that fraudsters will take it away. This is a very different prism from value or convenience. So anecdotally, we launched a product which we call SafePay, which right now is the world's only third layer authentication product using the SIM in the phone to serve an additional message which you have to accept or decline before your account gets debited. Today we have over 1.5 million users using it daily to protect their account. So the payment bank account has become by natural extension your safe secondary digital transaction account. Sure. So just to see this ecosystem, suddenly we see an explosion of activity on our side. Just a sense of the bank, we have 50 million monthly transacting users, which is far larger than many other banks. But we always feel a little humble because you have a telecom company which has 350, 370 million consumers on the other side. So there's massive room to grow and offer services. But 20 million of these 50 million are consuming our digital services every month.
Sure. And I completely understand. I'm understanding as a telecom player, your reach is far better than probably most of the institutions we see. But the jury is still not out in terms of the opportunity is 500 million. We have to scale to that level, but economic viability is still a question. And I think that's my last part of the discussion before I go to the audience for questions. And I am not seeing many of the people have cracked open the viable option around it. Though the asset class and the liabilities, the growth is still there, but the cost of service is still very high. I think it's operating between 6 to 10% of your total size of the funnel. Until we scale, it's not going to happen. Jan Dhan, I think that Trinity gave us some impetus, but that still has not been cracked open. I mean, my question to you is, how would one look at scaling and still making an economic viable model?
Yeah, so, I mean, great question. I think, let me share something, because it's a conversational chat. I was in Singapore. We represented India in the Singapore FinTech Festival. And there was a closed panel conversation of all the digital bank CEOs in Asia who had just come to discuss. Only 2 of the banks were profitable, right? The question is why? And therefore, the supposition is, why should India think any differently? Here's a simple framework to look at it. Today, a bank delivers services broadly at a cost of $100 to $200 a year per customer. In India, that number precisely is $100. Yeah, broadly, give or take, branches account for $500 of that. unless the direct bank is able to do a 10x efficiency and move that number to tens of dollars, it won't be able to sustain, because consumer uptake of products will always be less, given that you don't have a person to sell. Our analysis says that India is extremely uniquely positioned to deliver a low cost to serve because of the public infrastructure stack which India has built over the last 7 years. The core components of this is a biometric identity which can be leveraged at very low cost to deliver an effective KYC process, and a payment rail which is today delivering a cost of serve of 10 paisa per transaction. Once you have this, you can elegantly think about engineering a business model around it, which can deliver a cost to serve not just at 1/10th, but 1/100th. Our thought process is that today we are spending, give or take, precisely, around 18 rupees per user per month, 1/8. We also, by the way, happen to earn 20 rupees per user per month. And therefore, Airtel Payments Bank today is fully profitable. It turned profitable last year. But our thought process is, imagine a world where 50 million users go to 100 million and you start earning 30 to 35 rupees per month from that user. In India's per capita income scenario, where it's crossed $2,000, you still have a large user base at $500 to $700 per capita. You can earn potentially 30 to 40 rupees per month from that user base, which means you have an unparalleled bank of scale serving the very society and community which has endangered and built that license.
Completely agree. I have a last question related for you, but before that I want to go to the audience. Any questions for us? Just raise your hand and we should be able to bring the mic to you. Okay, my last part of the question related to the same thing is, people don't make money in CASA, frankly speaking. I mean, whether you're doing a banking in the urban center or whether you're doing, people make in peripherals, in other financial services to be offered. And that's where I think our country is lacking badly. I think it's more to do with awareness as well, but having the capability and capacity to do those services and avail those services is also an issue, right? But there is no one player who's actually addressing that issue as well.
Okay. I mean, I'm just sort of playing out the question in my head.
So notoriously famous.
So you basically, no, it's a great question. So you're saying that India, other income streams for a bank is underpenetrated because of various.
Absolutely.
No, you're absolutely right. Let me make 2 points. First is that if you look at the payment bank model, payment bank models for the entire industry, the only revenue stream 5 years back was payments, right? B2B payments, cash payments, digital payments, that entire piece put together. For the bank, for Airtel Payments Bank, it was 95%. The rest was 5% which came out of capital earnings and all of that. Today, it's broadly 77%. 23% is broadly fee and deposit income.
Got it.
Now, this will, in my view, move to 60-40. Maybe over the next 3 years, it will move to 65-35. But what India does need is a fresh look at how the consumers consume. So just to give you a sense, we are today India's largest micro-ticket, sachet-size financial services distributor. We distribute millions of small-ticket insurance policies. We are the 3rd largest distributor of Atal Pension Yojana, and we are slowly and steadily growing a loan referral business, all operated by a very large banking network, actually the world's largest banking network of 350,000 active banking points, and a mobile app embedded within a telecom banking experience.
Sure. And just last part, your views on digital currency versus no bank immediately required. Is that going to impact us?
Look, I think it's a great experiment. I would say we are very blessed to have a regulator like RBI who's very ahead of the curve. Let's not think about whether it will work or not, but let us answer, if it does work, how would it transform India? And to me, the benefits are two. The first, which is a rather small benefit, is that the cost of printing currency goes off. It's a small expense though. The second is that you would have virtually eliminated the informal economy and corruption in one single stroke. And therefore, while we do not know whether it will work or not, we all wish and hope that it does transform the country further.
Absolutely, but it poses threats to the banking community as well at some point of time. But that's a debate for a very long period of time to happen.
I mean, are you mentioning blockchain versus CBDC? Because CBDC poses no risk whatsoever because it's issued by RBI. Blockchain, look, we've seen the crash which has happened in the last 6 months.
No doubt.
So, you know, the jury is still out there as well.
Okay. What are the two things you will advise for people, especially working in the payment side and the payment bank side, to make the model economically viable?
You're talking about players, or you're talking about people working in the... no, I'll hold on to my horses. I don't want to give out any competitive edge whatsoever.
Okay. No, I understand this, but I think thank you very much for sharing your insights. I'm hoping there are no questions, guys. If you have, I can take one question at least from the audience. No, well, thank you very much. I think it's very interesting to see how Airtel payments have created a viable model, at the same time profitable model. There's a lot to learn from that, but there is still a scale, and there is, as I say, it's only the surface has been scratched. There's a lot from a potential of market as well. Thank you very much for being with us.
Thank you, Shalil.
Thank you, guys. Please give him a big hand.
Thank you very much, Mr. Viswas. Thank you, Shalil. And I'm going to request you both to please come together for a quick photo op. Well, I must say it was a super cool session wherein we gathered some insights. So I'll go with Shalil when he says it can be more of an iceberg chat rather. So thank you once again. And with that, we're now going to quickly set the stage for our next panel discussion. Stay tuned. We'll get our next set of panelists on board in just a couple of minutes. All right, ladies and gentlemen, meanwhile, I hope all of you are also participating in the conversation using the hashtag MintABC2023. You can also tag us at @LiveMint. I repeat, hashtag MintABC2023. With that, we'd also like to move ahead to our next session, but before that, I'd like to also take the opportunity to once again thank our associate partners for their fantastic support. We'd like to thank Union Bank of India, ThoughtWorks, and Airtel Payments Bank. And as you can see, once again, we're working around the logistics of the stage over here in order to bring on board our next set of speakers. But that being said, let me quickly share certain questions that are on our minds with regard to our next session. Now, how far have the measures that were taken up by the Government of India and Reserve Bank of India, how far do you think are these measures important for economic progress, and how much are they being delivered, and what more can be done? So that question will be like an underlying theme wherein we'll gather answers from all of our amazing set of panelists who will be joining us in just a couple of minutes. All right, so with that, we're all set to bring on board our next set of speakers. Our speakers are also all set. Ladies and gentlemen, the financial inclusion question. And let's welcome our speakers with a round of applause. First up, we have with us Udaya Hebar, Managing Director and Chief Executive Officer, CA Grameen Limited. May I please invite all our speakers on the stage. We have with us Rishi Gupta, Managing Director and CEO, Fino Payments Bank. Ramesh Iyer, Vice Chairman and Managing Director, Mahindra Finance. Anand Kumar Bajaj, Founder, Managing Director and Chief Executive Officer, Pay Nearby. And to spearhead the session, we have with us Gopika Gopakumar, Senior Assistant Editor, Mint. Well, can we have a thunderous round of applause, ladies and gentlemen, our penultimate session for the evening. And it's the big financial inclusion question. Let's gather the answers from our amazing leaders here. Thank you so much for joining us. And with that, I'm going to hand over the proceedings to Gopika. Over to you.
Check, yes. Good evening to all of you. Because we are the last panel before the big stellar panel which is lined up next, we have a challenge of making it interesting, financial inclusion interesting and relevant to all the viewers here. So financial inclusion as a concept has evolved over a period of time. It's mostly traditional banks. We associate financial inclusion mostly with traditional banks and bank account opening. But here I have 4 disruptors, so-called disruptors, besides these traditional banks. And to them we will be posing several questions as to how they're coping up with digital innovations, what is the business model that would evolve over a period of time, the regulatory landscape, and the way forward. So to begin with, let me first come to, so we have 2 players from the credit side, Mahindra Finance and Credit Access, and we have 2 players from the payment space. So very interesting panel that we have. Thank you, gentlemen, for joining us. We have seen a lot of competition. Financial inclusion is a very competitive space. Competition and digital innovation combined, how do you see yourself innovating or reinventing with time over the years, and what are the opportunities that you see over the next 3 to 5 years? If I can start with you, Ramesh sir.
Good evening, and thank you for this question. The question of competition comes if you have less of customers. And if you really talk of credit or any solution to that set of customers, there are many, many who are still not getting credit. So I think the problem of competition is because people are not willing to, or as a lender, we're not willing to go more deeper, create product that suits the needs of those customers, and are willing to live the difficult life of a customer by partnering him. I think if you're willing to do this, I'm not too sure is there too much of competition. Right? All of us want to concentrate in the same area. If somebody has started lending in an area, we think that's a great area. All of us want to go there and do that. And then you think there's a lot of competition. So at least for us, I can tell you that we have customers in 400,000 villages of this country. Now, I don't think we grow or not grow because of competition. It's because at that particular point of time, is there a need for something or not? Or is there a way that we can design a product and deliver it to them the way they want it or not? If you're able to do that, I'm sure that there is enough for everybody to do. Right? I think the other thing is, at least in financial inclusion space, my understanding, and I could stand corrected, is all about designing what the customer wants, not forcing to make them buy what you have. So if you're willing to bring that change to say, okay, this is your need, okay, I have a capability to design it for you, then there is enough to be done there. So at this stage, I don't think it's about competition, it's about your capability, your willingness, right? And your wanting to go that deeper and provide that credit. That's the way I would look at it.
So Uday sir, if you can.
Thank you. Thank you, Gopika. Pleasure to be here. I think what you're asking is about the competition. I think India, particularly in the financial inclusion space, we still reach just about 30–40% of the potential market. Particularly, I'm talking about Bharat, bottom of the pyramid. So therefore, we don't need to compete. There's a huge coexistence available to reach everybody in India. For example, our simple estimate is about 16 crore households are underserved. Of them, only 6 odd crores are served today. So we still have almost 100 million, or 10 crore. Particularly, 70 to 80% of them are in rural. We have not yet reached. So instead of competing, I think we have to collaborate and reach out there. And for example, most of us are collaborating to reach out there. I think that the entire, whether it's payment system or lenders or the banks or the SFBs or the entire system to collaborate and reach there. That's the importance today for all of us. That's one. About the reinventing, I think it's important to be relevant to the customers, as Ayarji said. The product suitability, process suitability, and price suitability for the customer, which will help you to gain the customer loyalty, which becomes a prominent pillar for your continuous innovation. If you keep thinking about product suitability, you keep innovating the product. If you keep thinking about the process suitability, you keep innovating the process. These two together will also help you to innovate and do a price suitability to customers. And similarly, employee centricity culture you need. So if you can build the customer loyalty and the employee loyalty, I think you can keep innovating, keep reinventing yourself, and keep resilience. You can keep a resilient business model. So I think that is what we can achieve over a period of time, innovating and being resilient and being relevant. Thank you.
I turn to the two players from the payment space, a very, very competitive space, so many players. In your case, Rishi, there are several questions about your business model. How do you ensure that you reinvent, stay relevant? Do you see even the payment bank model sustainable going forward?
Gopika, if I remember, you were one of the first ones to ask me this question 6 years back, 7 years back when we got the lessons, and I think the question continues. Unfortunately, payments space or payments bank are considered, or largely the payment space is not considered to be a very profitable space, so to say, because of the model which we have been running in the last so many years. But let me just try to differentiate the different kinds of payment ecosystems which are there. So when we look at payments ecosystem, we only look at the payment ecosystem around mobile apps and P2P transfers and all that. By virtue of the fact that a lot of those players have been heavily funded by investors and they have been having a long rope to become profitable, so they give a lot of this business for free. So that is why it's not a sustainable model. But the moment you start charging it, it will become a sustainable model because there are millions and millions, billions of transactions now happening on the ecosystem. Even 1 rupee if you charge on that transaction may lead to $1 billion revenue, so to say. It's just that the thought process is there not to charge. When it comes to the larger segment of the population or the 700-800 million population which we cater to from Payments Bank Financial Inclusion Initiative. So we have built up the model in which it's a very asset-light, scalable kind of a model. We have not put up branches. We also believe that we come from a banking mindset. We also believe that the customer has to pay for services. Nothing is free. There are no free lunches. So for any transactions we do, and thanks to the government, thanks to the NPCI, a lot of India Stack, PMJDY, all that which has happened in the last 5 years, especially the India Rails which has happened, has brought the cost of transactions to a very low number. And if the customers are ready to pay, because we bring a lot of convenience and ease to the larger masses of the country, the customers are ready to pay because now they don't have to travel so many kilometers, they save time in going to a branch. So they are able to we are able to bring a lot of convenience and ease to them, so they are ready to pay. And by virtue of the fact that we do basic banking services around cash withdrawal, deposits, remittances, cash management services, and the convenience we are able to bring to the customer, the business model has become sustainable. Out of I would say out of the 4 active payments bank, 3 of them are profitable now. One is on the virtue of becoming profitable. India Post being a government entity, they have a long rope. But the 3 private payments bank are already profitable. So they are making money. Now the question comes, over a period of time, can it become a sustainable model? Yes, with more products, more customers. And as my co-panelist Ramesh sir said, that competition is only a state of mind, and it is, India has a very big population. So there is enough room for everybody to play, and if you continue to bring innovation and customer convenience and ease, there is enough and more juice and enough and more products you can sell in the market.
How are you tackling this, Anurag?
When you have to reach 6 lakh villages where only 32,000 bank branches are there, I don't think there is a competition. When you cater to that customer segment where there are only 55,000 ATMs, most of them have struggled with cash, there is no competition. And if you are taking the high end of technology to the bottom of the pyramid, there is no competition. Your mindset determines what you are going to achieve. Like Uday said, collaboration is a great way forward, and that brings in a lot of comfort on viability, because then you are not standing alone in the market. Rishi, you mentioned in the side conversation that someone who dispenses insurance on top of your first line of service, that totally goes into your bottom line. That is a viability quotient enabler actually. So if you have laid the railroads into the hinterlands of Bharat, which is what we see as pioneer by, with 10 lakh retailers touching every nook and corner of the country, these are two-way transmission protocols with digital connected nodes. Sounds interesting. The micro entrepreneurs sitting there are there available to hit the ball out of the park, to do a commercial arrangement. So now bring on whatever services you can add to this platform and take it to the last mile, beyond credit, beyond content, beyond consumption. India and Bharat, they are waiting for it. So you granularize, sachetize, and universalize the services through this network is what we have been focusing on. We don't have the challenges of investor-driven profitability. We have a real long rope, and we did not have a choice but to be profitable at unit economics level ab initio. Of course, 6 months we started breaking even, and then went on with a small seed capital that we took from the family.
But the fact that financial inclusion still continues to be a concept where everything has to be given free. So how can we move from this thought process of this being a social initiative to a business initiative? Is that possible at all? Ramesh sir.
So I don't think the thought process is right. I don't think anybody is expecting, if it is financial inclusion, you will do it free. I mean, if you look at our balance sheet, 60-70% of the borrowers are first-time borrowers, right? And we give them a product like a vehicle or a tractor or anything else, and we kind of support them to be able to earn from that product, and then they repay you, right? And it comes at a decent commercial return. I think, again, I go back to, you need to identify the purpose for which an individual customer is looking for a support. It could be an investment side, it could be an insurance, it could be a credit. But if the business model is not able to recognize the purpose for which you are in this, you'll always think that I have to give it free, build a very large customer base, and then at a future date I'll try and do some cross-sell and make some money. But I think financial inclusion is not guided in that direction at all. I think we will have to provide this support for enabling the customer to raise up in their life, right? And we do that all the time. I mean, now I've run this business for 30 years, and all the time I've believed that the first time borrower of credit is a great credit. They never have an intention not to pay. They could have circumstantial problems. So I don't think it comes free. It's someone who's building a model to say that I want to give it free so that every customer comes to me, and then I'll control the market at a future date, probably must be thinking in that direction. But I think if you have a very focused approach to say you're building a healthy balance sheet which is commercially viable to sustain, I don't think the expectation is free.
Or is it that it is skewed more towards more against the payment players than lending?
So let me put it that way. When we talk about financial inclusion, the word inclusion itself looks like it is a social initiative. And when we started doing BC banking some 2006, 16, 17 years back, largely the mandates which were there that we have to do it as an inclusive mandate from the banks, And it was seen within the banks, largely public sector banks, that it is for the social good. So people in their own lead banks, where every public sector banks had lead banks. So it was the responsibility of the lead bank to ensure that a lot of inclusion happens in that particular lead bank district, whichever is under him. So a lot of accounts got opened, but hardly any transactions used to happen. So that model has completely changed now. Because of the penetration, and as Anand said, the lack of penetration of branches and ATM and the branch network and the banking network, a large network of merchants which have mushroomed all across the country, every nook and corner of the country. Now a bank account is open, you can deposit the money, you can withdraw the money at a very small fees. The banks are also quite happy because if all the customers, imagine 40-50 crore Jan-Dhan accounts which got opened in the last 5-7 years, if all of them come to a bank branch, how crowded the bank branch and the ecosystem will be. The ecosystem will not be able to handle that kind of number of people when they come to a branch. So that is where, from a social initiative, it has become a business, because the customer has also started to realize that it is better for me to pay 10 rupees for a transaction rather than spending 2 hours going to a branch, spending another 4 hours waiting in the branch, and I don't know whether the transaction will eventually happen or not. So from that point of view, the mindset of the customers, the mindset of the government, the mindset of the bankers, the regulator has changed considerably over the last 5-7 years, that unless and until we make financial inclusion like any other business opportunity, it is not going to scale up, it is continued to be on the social side. I think that mindset change has happened. People now want to go to this kind of new banking, just like they go to a mobile app and they feel they can do transactions, they go to a merchant and on a merchant app they can do transactions. I think that mindset change has happened, because of which it's moving away from a social mindset to a business opportunity mindset. That's why you see, as Anand was saying, within 6 months he became profitable. So the reason for him to become profitable was that the approach was more on the business side rather than on the social side. So that's where, especially on the payments and the BC model, that's how it has changed. Credit was always profitable from day one.
But we've seen that the government is still not, there is still a discussion on charges on payment. The Reserve Bank discussion paper is still out. So it seems as if the payment still is, the whole aspect, the perspective of payments is still undergoing some sort of change.
See, the fact that 943 million debit cards issued in the country, 400 million have ever been used, demonstrates that with low or no MDR, the 543 million debit cards which have expired, people are not interested in recarding them. The fact that of the 400 million debit active cards, only 200 odd million uniquely use UPI demonstrates that there are broken pieces. For example, many mobile numbers are not updated in the banking. You can't use UPI. This poster boy of ours can actually go 10x. Government does realize yesterday the 2300 crore of subsidy reimbursement for the transactions is towards that. The 1300 crore last year has become double almost. The idea is that you can consume credit capital content in the deep Bharat if the payment rails are intact. And it is important that there is enough inducement in making this pipe efficient, because it does cost a lot of server capacity and it takes a hell lot of code writing to process millions of transactions at a time. So I think there is a shift, and government, by the fact that they have come out giving this money, they want to ensure that this payment wire is intact so that you can actually transmit services to the mass Bharat. All these years, we could not accomplish reaching all these services to the mass Bharat, and most of the services have remained concentrated in urban center. But the moment the connectivity of the payments, the 123 Pay or the offline payment module that has been launched, UPI Lite, all these are initiatives towards taking people to instantly make payment and consummate a commerce. So I think main part here is someone who is able to connect this wire will be able to carry the current and illuminate the last mile. And when you do that, मेहंदी वारन वाले को ज्यों लगे मेहंदी को रंग, कबीर कह गए हैं, right? If you are doing good, you get benefit out of it. So I don't think it is just a pure charity line. If you are laying that wire and connecting and holding up there, you are in for a positive outcome from there. And government is mindfully, the PIDF from Reserve Bank of India, the Payment Infra Development Fund is encouraging enough to say, go, please deploy the digital payment rails. The changeovers which have happened on the prepaid card ecosystem, or for that matter, the controlled lending environment that has grown, I would leave it at that for now. But there is enough being done. The government is mindful. The ecosystem is evolving. Enough innovation is being brought in. The fact that inclusion is just not about account and payment. We bought an insurance broking license a couple of years ago, and we are trying to sachetize insurance 3 rupee a day. And that is what is picking up in the mass market. The fact that someone needs just 5,000 rupee credit is good enough for a player like us to be able to enable it basis the interactions we have, rather than a bank wanting to do a full due diligence for a 5 lakh rupee loan. So sachetization is a very, very critical phenomena, and you will see from FMCG and telecom that 10 rupee of a talk time made more profit, or a small Coca-Cola of 5 rupee that Amir Khan sold made more profit than a large pack.
But when you think of, when all of us think about financial inclusion, is about bank accounts and savings and credit. But we have not seen financial inclusion in other aspects of products, say investment, insurance. Uday sir, when do we see this?
I agree that the insurance penetration in this country is quite low, and particularly in the micro insurance segment. But if at all today micro insurance is in India, it's all because of microfinance companies. Actually today when I say 6 crore customers are lended by microfinance company, all of them have been insured. Top of that, their family members are insured actually. So the microfinance has actually contributed on insurance while partnering with many insurance companies across. But still there is a gap of designing the right product to customers. That gap is still there. But as we design more and more suitable product to them, I think there's huge market. The technology by the players to reach out there, and then delivery mechanism through whether microfinance or the payment banks or the pioneer bay kind of institutions, definitely we can reach out. Creating the suitable product for them, designing the product is important. More and more micro insurance companies, probably insurance is getting liberalized a bit. We expect more and more micro insurance companies coming into picture.
And you yourself are getting into it.
Our own group company is actually planning to start micro insurance company, so which is also one of the opportunity to innovate for this segment of people. I think there's large opportunity. It's one of the next, I think it is, as I say now, 2 decades back, microfinance was innovated and started. Everybody used to start microfinance, innovate the product. Probably today we are innovating microinsurance for everybody. There's a momentum for creating the insurance across bottom of the pyramid.
I just wanted to make a quick comment. Why is insurance and investment taking more time? First, recognize that do they have surplus to invest, and do they see insurance as their priority? Today they are trying to meet 2 ends, and which is why they are first wanting to take a credit. My personal belief is through credit, if you build their capability to earn better, then advise them that surplus could be put in insurance or that surplus could be used for investment. You will see that will follow.
But you all have been doing that for...
That's exactly my point. Like we started with credit. When we realized that they are earning enough out of the asset that we have provided them through the credit, there is a surplus, then we are able to mobilize deposits from them. Right? We are also able to give them insurance for their life as well as for health. Asset insurance anyway is compulsory, even regulatory, but the health insurance and the life cover is being able to be provided. I think fundamentally we should understand that their first need is to stabilize themselves and build a proper livelihood for themselves. And then will come the interest to look for anything else. And therefore credit will always be the start point. And through that, then you will see they are willing to participate in other products.
So when do you see that segment of population getting mature?
I mean, like you just said, right, if you are working with X million customer, in a year we underwrite loans for about 7 lakh customer. And we know for a fact that at least 70% of them or 80% of them take insurance. We have 10% of our deposits coming from that market or those kind of consumers. Again, I'll go back to my very start point. Do we have the right product for that market? My request and submission always would be, don't take a product from urban center and take to rural. Neither they understand, nor it excites them, nor can they participate in it.
Let's look at digital innovations. We've seen many digital innovations in India, India Stack, ONDC. As far as your sector, your business is concerned, which of these innovations do you see really helping that last mile? Uday sir, if I can start with you.
I think, it's important that the complementary working around with the digital players is important to reach the last mile, to reduce your cost, to reach the right products to the right people, to create, using the AI or ML to identify and create decisions for reaching out to the last mile customers, and then identify the insurance needs. You have more opportunity. There are a lot of data around with us, but we are not able to make it unless we work together as a system, not individually. So by doing that, there is an opportunity to reach out to everybody. So today, for example, in microfinance, majority of the collections are made cash. So it takes time for us to reach there. But there still we have some more challenges, because the infrastructure challenge is there, ecosystem challenge is there, digital literacy challenge is there, because rural is not India right now. Rural is still Bharat, right? You need to get into the customer, first getting into a smartphone, then getting into the understanding the entire data usage, then the financial transaction usage. I think it's a journey. It started from urban going to rural. Probably 30-40% of them are adopted, and the 60% are adopted in 2-3 years. Then there's a high opportunity for delivering all possible products to this last mile. I think microfinance companies, small finance banks, payment banks, all of them are intermediary to reach those products to the last mile customers. Technology is the only way to reach there. Without that, it's difficult.
To add to it, see the Open platform, the protocol of account aggregator is one hell lot of innovation which will help reach credit to the last mile with data accessibility to the consumer without taking a PDF and uploading. The 123 Lite, the offline payment of UPI is an enabler. One nation, one card is a great enabler. So I think there is enough quantum of innovation that is happening in the mass market. Plus little offbeat, but ONDC is yet another icing on the cake where mass retail gets onto the bandwagon of e-commerce, the open network for digital commerce. So there is a lot of work happening. India Stack, certainly it helped India and Bharat both survive through the entire prolonged lockdown. Imagine if UPI were the only one term for payment, Mass Bharat could not have accessed the subsidy with the Aadhaar-enabled payment system. So I wanted to thank Praveena Rai, she was here and I keep doing it often, that what a platform it is, why NUE is required at all, when one infra of NPCI could cater to the tech-savvy UPI consumers and the AEPS segment. And by the way, the AEPS segment is a backup of ATM, where the ATMs in Bihar are underwater during flood. Pratakshamev Pramanam, the thumb is up above the water, and which is what the entire Bihar at least receives funds through. So there is enough relevance of India Stack and what is being built alongside on top of it. AI/ML, certainly the artificial augmentations beyond. I don't want to miss the fact that what the lenders also do is the human intelligence at the last mile, the way the credits are assessed by the local people. For example, we have built a credibility score, a Bharosa score. Most of our merchants are first to credit, new to credit, and banks would have normally not lent, but for the transaction pattern that we saw. And then we asked the bank, would you want to lend my retail merchant? And there you go, the pipes have started, the banks lend directly into the bank account. I think it's a broken piece that one has to identify and then go for fixing it. And that's what I was saying, there is no competition. There's huge opportunity to innovate and take it to Bharat.
I think most of it is already covered. Anand listed out all the innovation which is happening. I think most importantly, which I feel, is that any innovation has to be given time before we write it off. So UPI itself is a big example, the way it has now entered our lives, our daily lives, everything we do on UPI platform. So similarly, a lot of platforms which have come up in the last 3 to 4 years are now in the stage when they are now going to the market. One thing which we need to focus on, and I think Ramesh talked about, is to tailor make the products around that innovation. So one shoe will not fit all. You will have to build shoes or build sizes according to the needs of the customer. So if there is an ONDC platform which is coming up, ONDC platform in an urban or a Bombay like a metropolitan versus something like a remote village in Varanasi could be very different. An account aggregator platform for a general public will be very different from the requirements of the rural village, whether you can actually aggregate or have information. The CKYC platform itself has been a big innovation. All the KYC is now at the central level. Are we using it enough so that we can, rather than doing re-KYC again and again, can we do it? The inter-regulatory KYC issue has been discussed quite often, but now can the same be used by SEBI? Can the same be mutual funds, insurance? All of them can use the same CKYC which is there. So my belief is innovation will continue to happen and should happen. The adaptation of innovation basis the needs of the customer is the responsibility of companies like ours, that we make products which are, the innovation is happening at the pan-India level, at the global level, when we look at from an India perspective. A lot of India stack innovations, but can we adapt and make it useful for our customer is what I would look at in the next 2 to 3 years.
I think finally I would like to look at regulatory landscape. I think that is something which touches across all the players. Is it too restrictive? Is it progressive? I'll start with Ramesh sir. As an NBFC, RBI wants NBFC, the regulations around NBFC to be at par with banks. Where do you see, is that becoming too restrictive for you to evolve as an NBFC? Or do you think the way forward is to become a bank, provided they allow corporates to become a bank?
I think one shouldn't think of becoming a bank just because the regulation is becoming too difficult, right? I think we should ask very basic question, what is the value proposition that you're trying to drive, and is there a taker for that? And if there are, then I think any format will survive. I mean, as NBFCs, we've seen many ups and downs over a period of time. And every time there is a new regulation, obviously this question will be asked, oh, is it too difficult, too tough? I think instead of questioning the regulation, it's always better to question the business model. And you will find that the regulation is able to go into the model extremely well. Let me just give you one example. I remember very early days, NPA was 365 days recognition. Even that time, all of us felt it's very difficult. It became 180 days, we felt, oh, what has happened? Then it became 90 days, we said, oh, what has happened? Today we are talking of daily stamping. Everyone has accepted. The rule has become a practice and it's not disrupted the market. Right? I think fundamentally one should ask a question, does this regulation, if followed well, does it strengthen your balance sheet? And our experience has been, it's very difficult to immediately accept and put it to practice because it's all about customer accepting it finally, right? But if you do follow the path of communication and continuously educating the customer, and it does become acceptable, your balance sheets become extremely strong. And which is why you sustain a model and then you become larger and keep going, doing big things. To your point of will you become a bank, I want to confirm to you that we are not wanting to become a bank because the NBFC model doesn't have a future. I don't think that's our take at all. Even for a minute, imagine that tomorrow we are told, yes, you can get a license. Will we simply junk this model and say, oh, tomorrow we will want to become a bank? I don't think that's so easy. You'll have to ask very clearly, if as a bank you want to continue to do what you're doing as an NBFC, do you want to become a bank? Right? Or do you see there's no headroom for you as an NBFC to grow any further, therefore do you want to become a bank? So therefore you have to ask this question, at least we believe we have to ask this question from the liability side. not from the asset side. If you can't raise capital enough, you can't raise enough debt, and you think, oh, then where are we going to grow? Right? Then you may want to ask that question. But our belief is both models have a good coexistence possibility, as a good headroom for both to grow, and which is what is co-lending all about. Both can work together and make a difference.
I would say we are in a very good times in India. The regulator is very forward-looking. The fact that setting up of Committee for Deepening of Digital Payments initiated by the regulator, the regulatory review board where the regulator opened up itself to say, please send me inputs where changes are required. The RBI Innovation Hub setting up is demonstrative of the fact that regulator wants a lot of good disruption to happen. The sandbox itself, a regulator running a sandbox demonstrates quite forthcomingness of the regulator. While Nandan does say that innovation leads regulation, and there are initiatives that have to be taken to mend broken pieces, and regulation soon helps it bring into governance fold and make it much more sanitized for customer grievance redressal starting from there. And then of course looking at the viability, how much is good, and the public good debate that we all have, how good is public good. But it all certainly, I think, the SEBI coming up with a sandbox or a IRDA coming up with a sandbox, I think there is a mindful initiative into facilitating innovation.
Final word from you guys.
I think, regulation, at least for last 12 years I have seen, regulation has been very progressive for microfinance at least. So, they allow, but they made a regulation which is helping with borrowing, with the self-regulatory body, the credit bureau in place. I think because of the regulation, India become one of the best place for microfinance in the world actually. So, and the most efficient microfinance system is enabled. Then the regulation kept on progressively improved, and as recently, actually they made, I think probably recognized that one of the well-managed business, and then removed the price restrictions, removed the loan product restrictions, some of the restrictions removed and make more progressive. So I think it's and then in between they allowed so many people to become bank. At least 9 or 10 of the MFIs become banks, 1 become universal bank. I think it's amazingly progressive regulations. And on NBFC, because I follow both, I have to follow NBFC regulation, MFI regulation both. I think it's all progressive, more strengthening of balance sheet. Like he said, NPA stamping or NPA. So when they made 90 days, we made 60 days actually, to be more progressive than the RBI prescription. So we recognize NPA at 60 days to be more stringent and recognize the risks much ahead. But it's important to recognize the reason for such regulation is improving to strengthen the balance sheet, strengthen the ecosystem, economy. So I think it's welcome. Of course, sometime we need to get some implementation gap and time. I think they're ready. Every time they come and extend the other 6 months to implement this. But it's good actually. So we are quite happy about it.
Okay. Thank you, gentlemen, for joining us. So I hope next year when we meet or whenever we meet, I hope you will continue to be in the same business and continue to do the same kind of good work and further financial inclusion. With that, thank you, gentlemen, for joining us. Over to the MC.
Thank you very much, Gopika. Thank you to all of our speakers for joining us. And if I could request you all to come together for a group photograph. Thank you very much. Invaluable expertise and experience. That's what we managed to gather from all of our speakers here so far. That being said, we are also about to get up within the next few minutes for our final session for the evening. So I'm hoping all of you are going to be seated and all get up for the final session. We'll get it started in the next couple of minutes. Please be seated, everyone. Thank you. Ladies and gentlemen, our next session is about to begin, so we're going to request everyone to please take your seats. Well, that's always bound to happen after a good discussion. There's always supposed to be a post-discussion. We're not going to stop that, no problem at all. But just that in the next 2-3 minutes, I'm going to request everyone to please take your seats. We can't wait to have the stellar panel and we can't wait to get up to listen to some of the leaders joining us for the final session for the conclave. All right, ladies and gentlemen, a humble request to everyone. We're about to get the session started, so if I could request all the members of the audience to very quickly take your seats. We managed to gather the answer to the financial inclusion question, and now we come to the final session for the conclave, and this is where the discussion will center around how banks are planning to navigate the next round of credit growth. And I'm sure all of us are equally enthused by the topic, by the kind of speakers who are joining us. If that's the deal, then I'm going to request everyone very quickly, please take your seats. The final panel for the evening, how prepared are banks for the next credit cycle? So let me quickly go ahead and also invite our speakers as they're all set to share their thoughts. We have with us Hitendra Dave, Chief Executive Officer, HSBC India. So if I could please invite Mr. Hitendra Dave. All right, I've been informed, still on the way, so we're just going to hold on for another minute. Well, that being said, meanwhile, I'd like to once again urge you all one final time for all the conversations that we've been indulging in. You can also go ahead and share your tweets, your thoughts using the hashtag MintABC2023. You can also tag us at @LiveMint. And of course, we'd like to once again thank our associate partners for their fantastic support, for helping us put together the 15th edition of the Mint Annual Banking Conclave. We'd like to thank Union Bank of India, ThoughtWorks and Airtel Payments Bank. We've had some riveting discussions that started back in the afternoon, and it all culminates to this very moment wherein we're here for our final panel discussion. I've also been informed by my team members that our speakers are just joining us in. Looks like the pre-group discussion has already begun. We're just going to hold on for a minute or two and then get the session started. All right, so I've been told that all speakers are in. That means it's time to also invite them on stage. And first up, ladies and gentlemen, may I please invite Mr. Hitendra Dave, Chief Executive Officer, HSBC India. May I further invite Mr. Prashant Kumar, Managing Director and Chief Executive Officer, Yes Bank. Mr. Sanjeev Chadha, Managing Director and Chief Executive Officer, Bank of Baroda. And to spearhead the stellar panel, we have with us Raj Rishi Singhal, Policy Consultant and Senior Journalist. Ladies and gentlemen, this is our final session for the conclave. Can we all come together and have a phenomenal round of applause, a dynamic round of applause that matches the dynamism of all these leaders who are joining us here this evening. And with that, thank you so much, gentlemen, for joining us. I'm going to quickly hand it over to Mr. Raj Rishi to take it forward. Over to you, sir.
Thank you so much. Hello, good evening, and a very happy new year to everybody. Thank you for staying back. This is the stellar, the crowning glory of Mint's Annual Banking 15th edition. And we have a stellar panel of senior bankers here with us. So before we begin, let me quickly lay down the context. So I would be repeating a truism if I stated that we are going through a very challenging, complex and difficult time. The economy is in flux, inflation has been high, unemployment is rising, and we have a global economic slowdown knocking on our doors. In the midst of all this, we have tons of confusing and contradictory data. Let me give you one quick example. While vehicle loans are going up, we see passenger car and two-wheeler sales stalling. Go figure. So let me also take a bit of a liberty and paraphrase what Shakespeare said. I think very clearly we are in a winter of dissonance. And to help us see through this fog of uncertainty, we have these three bankers, very senior bankers. Mr. Sanjeev Chadha from Bank of Baroda, Mr. Dave from HSBC, and Mr. Prashant Kumar from Yes Bank. And because of the institutions they represent, we hope to get a much better and a rounded view and some clarity of what lies ahead. It's dangerous to give a journalist a mic. So I'm going to stop here and I'm going to, get down to the questions. Ms. Chadha, question to you first. The revival in credit growth over the past few months seems concentrated in NBFCs and the retail sector. Surprisingly, the corporate sector has been coy, very coy. Despite all the inducements of low taxes, low interest rates for a prolonged period, schemes from the government like PLI, and government spending on capex to draw in corporate sector, but corporate sector has refused to play ball. What, in your opinion, will get the corporate sector to start borrowing from banks?
So thanks very much. I think as you said, there is a fair bit of confusing information, and I'm not sure whether I have all the answers. But my sense is that when it comes to the corporate sector, we are seeing a very fundamental shift in the environment. One is that over the last few years, the corporate sector has deleveraged very, very substantially. Number two, in terms of sponsors of large projects, large capex, I think the set of corporates who would do that has narrowed very substantially. And this narrow set, these companies which are deleveraged, they have choices and they also have the power to make sure that they get the best deal wherever it is possible. So therefore, again, if we were to look at past periods where there was irrational exuberance that led to, again, very high demand, and that demand in turn led to, again, banks again lending probably again a bit illogically, I think that time is not going to come back. The kind of borrowers we have are very mature people. They are people who actually have very deep roots in the industries in which they function. So I think banks will probably have to settle for probably lower margins, but the upshot is going to be, it's going to be much better quality of credit as we go along. The second part again is that in terms of choices, I think there's been a prolonged period where in terms of interest rates, the markets abroad presented a very viable option. That is beginning to change now. So quite possibly again you might see a bit of redirection of demand towards the rupee market, but that's something which is still taking shape. The third part is, if you see which are the areas which have grown, to my mind there's also a very clear message there. Wherever we have been able to present a viable option for corporates to make a risk-adjusted return, the investment is coming. And a case in point again is the road sector, where we learned from the challenges of the past. Now, if you want to do a road project, the market risk has been taken out substantially. In terms of return, it is decent, and actually there is a lot of demand which is there. So I think what is behind us is the time when there was indiscriminate investment without looking at what is going to happen, assuming that the demand will fall in place ultimately. That is probably behind us, and I think that's good for the economy and good for the banks also.
So just one quick follow-up. You said there is substantial deleveraging, but there are some reports which suggest that that might be a bit of a mirage, because many of them have actually plowed back earnings into investments, which makes their debt equity ratio look good. And the absolute amount of outstandings has come down, but not by a great extent. Do you subscribe to that view?
To a limited extent, I think it might apply to certain cases, but as banks, you normally, when you look at the leverage ratios, you make adjustments for the point that you have made. And if you look at leverage ratios, even adjusted for that, I think it is still something that stands scrutiny.
Okay, interesting. So this is a question for everybody. Are we going to see a structural shift in the way the credit market, is going to develop in the next few months or the next couple of years, where you see corporates borrowing through bonds for term and using banks only for working capital? Do you see that structural shift happening? I mean, it's open to all of you.
So I think unlikely. I think in terms of the terms that the bank offer, very frankly, in India, on a risk-adjusted basis, they are very, very favorable. I don't think bond markets are likely to match that. In fact, you can almost argue that particularly when it comes to project finance, there's a substantial mispricing of risk which is there. So I don't think that is a possibility. The other thing which again I would just want to point out is that there is a structural shift also to the extent in terms of who your sponsors are. From again promoter sponsors, family sponsors, you're moving to financial sponsors. Now in terms, again that has implications both in terms of credit quality, in terms of due diligence, the quality of investment decisions, and also again what you're likely to see as you go ahead.
Anybody else would like to?
I think I'll just add to the points Mr. Chadda made about the nature of credit demand. I think we all grew up in those days where 50,000 crore projects, 70,000 crore projects were announced, apart from possibly not the quality of appraisals that level of lending deserves. We also didn't look into the kind of equity, the quality of the equity that's come in. So I think those of us waiting for those days of credit where 30,000, 50,000, 70,000 of which 60, 70, 80, 90% is financed by banks, I don't think that's going to come, and I don't think we want it to come, quite honestly, because we now know from our own experience that lot of that, there was a significant amount of padding up there, right? So that's part one. I think the second thing also is that I think banks have also learned from the very, very expensive and heavy price that the industry has paid, right? As recent as just 3-4 years back or so. So concentration norms, single borrower limits, not just the single borrower limits imposed from a regulatory perspective, but what it does to your profitability or what it does to your capital. So I think will play through. My own sense is it won't be the bond market which finances the next round of credit growth. I think banks will continue to play a very active and a very large role there. But My sense is the next round of credit growth will be much more granular as compared to the previous rounds where individual banks had single borrowers of, very substantial amounts related to the size of the balance sheet or size of the capital for sure. So I think this drive towards giving money to retail, giving much more money to medium-sized companies, small companies, on the back of an ecosystem which has got created, which facilitates it today, which wasn't possible as recent as, let's say, 3-4 years back or so, I think is a more a structural shift. From an industry perspective, that shift does inherently make the banks a lot more safer, and banks need to be banks. You need to, everybody in this audience, you do strange things. You don't tell anybody else in your family how much money you have, but you come and give it to a stranger in the counter. So it's a special industry, and all of us, I think, are hopefully trying to reflect that in our day-to-day behavior on the asset side as well.
So I think the first thing that we need to just shift from very, very large corporate to a different segment, which is the medium enterprise. Okay? Because large corporates, they would be very few, and like what Sanjeev was saying, they would also be having the multiple choices. Depending on the time, the choices can be the bond market. If the international borrowings are cheap, they can go overseas also, and they would not be borrowing from the Indian market. So I think the way the Indian market is moving, the shift has to be absolutely from the large corporate to the medium enterprises, going further to MSMEs. And the large corporate, they would be very price sensitive, the cost part, but they would be very few. Okay? But I think going forward, at least I think the observations made by you, I would be having a slight difference of opinion. When we talk about the uncertainty, I think this is not uncertainty which has come to us for the first time. I think we continue to live in this world of uncertainty, and every time there would be a different challenge. But I think the way our economy has been able to respond and the country has been able to respond to the different challenges over a period of time, I think it gives a very, very positive comfort to all of us. So I think we need to see in terms of what we talk about, the resilience or the responsiveness. I think that way the financial sector and on the corporate also, everybody has moved in a very positive way.
So here's a question for you, Mr. Prashant Kumar. So as I started off by saying that the credit growth has been seen mainly in credit demand from NBFCs and retail customers. So can banks sustain this kind of credit growth? And in which kinds of segments do you see robust credit demand continuing for some more time?
I think we are seeing growth from...
In retail, I meant segments in retail lending, consumer lending.
No, fundamentally, like if we also need to see the size of the market. So I think there has been a lot of talk in terms of everybody is focusing on retail and what is going to happen. But I think if you see in terms of the size of the market, there has been a shift from unstructured sector to a formal sector, NBFCs to the banks. But the issue is not always in terms of liquidity or capital. I think sometimes we think about that whether banks are prepared, and banks are prepared in terms of you would be having a sufficient liquidity or the capital. But I think today the issue is more in terms of your capacity to handle such a large market for the credit. Okay? And I think there, again, it has to be how we can automate. How we can automate the onboarding of customers, how we can automate the credit underwriting, and how we can automate the collections. So I think in the retail space, I don't see there is any issue in terms of competition. I think there is a huge scope which is available, but anybody who is able to move on the automation of the entire credit process, I think they would be able to handle it very well.
What kind of segments do you see, credit demand remaining robust over the next few quarters?
No, I think what we are seeing, it's across, like whether you are talking of the vehicle loans, home loans, even rate of interest are going up, but I think we are not seeing any slackness in the demand on the home loan side.
No, I mean, latest, RBI data shows that one of the highest growth is seen in advances against fixed deposits. Now, do you see that as sustainable?
No, I think again advances on the fixed deposit is also a function of the pricing. Okay. Because sometimes if your credit requirement is only a temporary thing, okay, and if you are getting a higher rate of interest on the fixed deposit, then I think this instrument becomes better for the individuals. But we are also seeing a lot of demand for the consumption, lot of demand for even creation of the assets like maybe the home loan, the vehicles, the consumption. But I think the whole landscape on the lending, whole landscape in terms of the behavior and the requirement is changing very fast. So I think we can't think in terms of what banks were doing for last 20, 25 years. There is a huge behavior change in the customer profiles.
So the question for everybody, in a rising interest rate regime, in which part of retail lending do you see risks are rising?
I think Sir already mentioned that you would expect that to be in mortgages, right? You would expect that to be in mortgages because the ticket size is large enough for the interest rate to make a difference. Otherwise, quite honestly, if you look at, you look at cards, right? The rates are such that policy rates have nothing to do with it. I mean, you can take policy rates to 3% or take the policy rates to 9%. The card, anybody who's borrowing in cards is borrowing for very different reasons. He's a rate insensitive borrower, if I can call it that. And then if you go to unsecured personal loans, most loans are at double digit, but somewhere between 10 to, let's call it 10 to 13%, 10 to 14% or so. And in the banking industry at least, I'm not getting into.
No, in the banking, I meant
yeah. So
banking, yeah.
Again, this is only pricing for credit risk. The pricing is only adjusting for credit risk as opposed to cost of liquidity or cost of raising deposits because the margin on paper is quite high. It's just the risk adjusted margin which comes down. So mortgages is the only one where you would have expected, but given the LTV norms that most banks follow, right? Given the LTV norms that most banks follow, I think banks do a much more thorough due diligence on retail borrowers than we do on infrastructure borrowers, is my assessment. That, you ask for 10,000 crores, we'll ask you less questions. You ask for 1 crore loan, we will, what is your name, what is your spouse's name, or how much is your salary, we do that, what profile of employer you have, is the employment, for example, if you're working for a public sector company, you can almost safely assume that this is as, it will continue kind of a thing. So I think rising rates and credit risk in the portfolio at this juncture, I don't think, and also we are not talking about rates going in like a European condition from, where you had 20-year fixed rate mortgages at 2% and now suddenly the floating rates have gone to 5, 5.5, 6. It's a very dramatic shift. It's like a multiple. In our case, the lowest mortgage rate was 675 or so, and those same banks now might be at 8.5, 875. I think 200 basis points, given all the factors that I don't think rates will be a problem. I think the only risk in the retail book, this is at an industry level, is we have never experienced a period of mass unemployment. That's the one big risk, and informal sector. And I think nothing in the horizon suggests that we are about to be there. So I think retail with the ecosystem that we have in terms of the credit bureaus and the other multiple checks, I think and the granularity. I think you will have losses, but it won't have the kind of challenges that we experienced as an industry 5 years back.
Yeah, just again, for emphasis, I think a few points. One is that when we're looking at interest rates now, they are not that they are at unprecedented levels, never seen last 20, 30 years, right? So they are pretty much where they were about 3 years back. That's one. Number two, if you're looking at, again, say MSMEs or even large corporate borrowers. So we had done a survey of some 2,000 odd clients, and you find that the interest coverage ratios are better by an order of magnitude. So it's extremely unlikely that stress should get transferred because of interest rates. Third, when you're looking at the retail book, ultimately what happens when interest rates rise, right? Your length of a loan gets adjusted. It does not really have too much of an impact in terms of, again, what you need to do today. Normally the challenge happens when banks actively dilute standards and then enable borrowers to borrow more. I don't think we have seen evidence of that. Most lending in India is driven very strictly as per the credit profile scorecard of the borrower. So I don't think there's any reason why if we have not reached a stage where even demand has been impacted, even less likely that credit quality should get impacted.
Mr. Dave, coming back to the same theme of bank credit growth being focused on NBFC and retail, but mostly let me focus on NBFCs. In the current year, we see fintechs come into play, and bank lending to fintechs is also expected to go up. Now, both NBFCs and fintechs, in some senses, achieve your last mile outreach and reach to the final consumer. So, are commercial banks also becoming refinance institutions instead of reaching out to the ultimate customer, intermediating through NBFCs and fintechs?
No, so I think one thing I would say is it's not like I don't think banks are focused on NBFCs. I think it's the other way around, that's the one borrowing segment. Okay, so you don't set out to look for only NBFCs, but if, to the point Mr. Chadda made earlier, if there is significant amount of deleveraging in the industrial sector, for reasons we all appreciate, just as banks had the challenges, the mirror image of that was in the corporate sector, and therefore boards have told them to operate with much better net debt and equity issues, ratios, etc. But it is a fact that in India, the reason why, at least in my view, the reason why NBFCs became as prominent as they did was because banks were either lazy or did not want to go down the curve, did not want to adopt the new practices. Maybe our structures and our regulatory environment also doesn't allow us to do certain things that other lenders can. This is a plethora of reasons, but you have to give credit to the NBFC sector also, because there have been spectacular failures, but there have also been very, very well run NBFCs, and there I think the industry has to learn. They have, all of us want to lend to the salaried, but there are NBFCs which are lending to the self-employed and doing a great job of it, right? So things of that nature. So I think it's not that. I think your point on, you can always, banks are intermediaries at the end of the day. We intermediate between depositors and borrowers. And so if there is one more layer of intermediation, I think at the NBFC level, you can see it on the one hand as, okay, you are not doing things that they are, but you also have to be honest to yourself. Just because some NBFC is able to do low cost housing, are you, for example, or lending to self-employed or to small business, if it's not in your systems or risk appetite, it's better to let someone else who does a better job and reduce the risk and obviously reduce your margin. On the fintech part of your question, my own sense is the banking industry has realized that I think there was a gap. They allowed NBFCs to grow to the extent that they did, but now almost every bank is a reasonably good, it's the amount of spending on tech, the amount of time that I'm sure managements and CEOs and boards are spending on technology. I think you will increasingly find banks looking to partner with fintechs, as opposed to fintechs per se. I don't think will get the kind of credit, because let's face it, they're a cash burn model, so any lending unit will have constraints on how much they want to put out there.
Anybody would like to add? So I think just 2 points. One is that if we were to compare with what the situation was 5 years back, in fact maybe about 4 years back, there is BCG data which says that the share of credit put out by NBFCs as part of the overall financial system was as high as 50%. That has come down substantially. So if we were to compare that, it's not that, again, if what we see now is actually, you might say, where the curve has turned, is the other way. The banks have been able to reclaim a fair bit of ground, and I think, as again Mr. Dave said, that is probably the way it should be. There'll always be unexplored, underexploited, difficult to reach segments where NBFCs reach first, and as you go along, the banks engage first through NBFCs and then directly through customers. Number 2, even in terms of the banks doing lending only to NBFCs, I can only just again give data in terms of BOB. Now our share of NBFC lending in our overall book actually has come down by a few percentage points over 3 years, right? But still you are growing your credit at about 20%. So it's not that the other opportunities are not there, but this is a bona fide, legitimate avenue to again do lending, and also it's something which is very complementary to banks.
So question to you, in the past 35, all of this credit growth is happening without commensurate growth in deposits. Over the last 30, 40 years, we've seen the phenomenon of loan melas. Do we see deposit melas also now?
So I think there's a very large element of recency bias when we talk of deposit growth not keeping up. Again, just a data point, in terms of the CD ratio of BOB, it is the same as it was 3 years back. But within the 3-year period, there would have been periods when deposit growth was more, there were periods when deposit growth is slower. Number two, as you talked about again in terms of loan growth, what you see in certain segment, car loans for instance, there's obviously an issue in terms of pent-up demand which is there. There's no way car loans are going to grow 44% year after year, right? So there is again, I think, the present situation where there was pent-up demand, where the base effect has come in place, but I don't believe there's any paradigm shift which would allow us to think again that deposit growth should become too much of a challenge. Yes, there will be some structural shifts. I think we have seen data in terms of managed funds as a proportion going up. But again, we have seen post again the sharp fall at the time of the pandemic, the equity returns for retail investors come pretty much in a manner which was indiscriminate. I think unlikely that you would see that continue indefinitely.
So here's again, you mentioned structural shift. So here's another thought that crossed my mind, and this is for all of you. I see banks now willing to borrow via CDs and pay higher rates than for FDs to retail customers for similar tenors. Why is that happening?
No, I think if you see overall, the proportion of CD would be very, very minuscule.
Maybe, but at the same time,
hardly anything.
Pay more.
Because sometimes what happens, you also need to take the requirement of your LCR and NSFR, okay. So maybe just to meet some of those specific things, some of the banks would raise money through CDs, but otherwise overall, it's always through the customers. So I think if you see any bank, numbers would be hardly 4,000-5,000 crores, that's all. Whereas the deposit, overall deposit would be very, very high. So just sometimes to meet some specific requirement, those CDs are being.
But also just to come back to credit growth, in all of this talk of credit growth, again, partially because of, base effect, do you see the first initial incipient signs of credit growth easing up, plateauing? I'm not saying coming down, but, easing up.
So I think even if you were not to look for signs, the fact is that if you look at credit growth over extended period of time, it has to be at the end of the day nominal GDP growth plus say 1.2 times or whatever, right? So I think what we are seeing now is entirely out of sync with what would be a sustainable level. To that extent, I think if there are signs, I think there are signs of what is very frankly inevitable. I don't believe this is the kind of levels of growth that we should be looking at indefinitely.
Mr. Dave? There's one more there actually.
Oh, sorry, my apologies.
No, I think there's external factors also, right? Nominal GDP is about inflation plus the real growth. So as inflation tapers off, then I think the other thing is the amount of inventory that everybody was carrying due to the uncertainties caused by supply chain, etc. So most businesses were carrying more inventory because they didn't know when the demand would come. As supply chains have repaired, you go back to normal levels of inventory maintenance, and that inventory is essentially financed by the banking industry. There's also indications that the demand from the West is softening a little bit, right? So that's not India now is a fairly large trade economy, right? We've got between imports, exports of goods and services, we are now more or less $1.5 trillion. It's not an inconsequential number anymore. So to the extent that, for example, if Macy's or whatever these stores in US, they are not taking in fresh orders because they have not been able to clear previous inventory. Everybody down the chain then will borrow less, whether it's cotton, whether it's material, whether it's whatever else. I think that's and plus commodity prices, right? I mean, if commodity, we finance volumes, right? 1 kg of steel, 1 kg of coal, 1 kg of zinc, 1 kg of whatever. If that 1 kg was 100 and now it's 65, it's 65 unless the demand has grown 50%, which obviously will not. So I think there's external factors, but I think nothing in the economy would suggest that growth rate should come off. I mean, apart from the inflation-related factor, I think we are on a long. My own sense is we are on a long runway of growth, both in the retail segment as well as in the MSE segment, because as a proportion of macro variables, we are still relatively in the middle of the pack. So there is scope for us to lend a lot more into the consumer sector as well as the MSME sector and still not get it to levels which could make it a macro instability factor.
Mr. Prashant Kumar,
I think we should not see in terms of like 19-20% kind of thing, because this is a mathematical outcome. Okay. But fundamentally, if you see in terms of economy, I think our credit growth, the way we are seeing, would continue to be very good. Maybe in the double digit always, but maybe 13, 14, 15% kind of thing. And first, because of the large market, and also because of the overall improvement in the lifestyle, the aspiration and the wealth which is moving up. So I think when I am talking about the size of the market, I am saying the way the money is moving or the wealth is moving, but at the same time the aspiration of the population is also very high. So I think we are definitely in a very sweet spot, and the credit growth from across the sectors, at least the way we are seeing, would be quite positive over a period of time.
So, you mentioned, Ms. Chadda also mentioned about the phenomenon of, micro, small and medium industry driving credit growth. But recent data over the past 2-3 months shows it tapering off. Is it part of the same reason, or is there something else that we should know about?
No, I think fundamentally like this data which is coming, again, what I would be saying, there are certain like base effect. Sometimes because of the seasonality, okay. Sometimes also because of the kind of the supply chain issues which are there. But fundamentally, we are not seeing any kind of, say, the delinquencies or the sickness in the MSME space. I think this is also the time where we should not start thinking that if market is growing and we start immediately talking about where there would be higher risk factors. And why I am saying this? I think on the retail side, if you see the banking sector for last 4 or 5 years, there has been a growth on the retail side only, right? We have passed through very, very difficult times of the COVID. But I think nobody has seen the kind of delinquency which people were expecting, even during COVID or after COVID.
But because there was moratorium and there were forbearance by RBI, right?
No, but I think after that also, if you see that moratorium period and the forbearance, that period is out. Everybody has already come into that cycle where they have to repay. So I think when we have passed through such difficult phase, that is the ultimate test. And the retail, the entire banking sector is growing for last 4 or 5 years. So I think we really need to move into a mindset that immediately when the growth starts, we should not think about the risk. Because today banks are, I think, very, very careful in terms of the assessing your customer. This is not like 10, 15 years back, where the loan was simply given on the basis of the customer face or his name kind of thing. I think there has been a lot of due diligence, which is also helped by the data.
And family name doesn't matter anymore. Yeah, so one last question for each of you. It's a common question, but I want each of you to reply to that common question. What are your expectations from the budget, which is, just less than 3 weeks away, Mr. Chadda? For banking sector, just the banking sector.
So I think in terms of the banking sector, probably we're not really looking at any direct steps which impact banks, in a manner which is very straight. But I think probably what we are looking at is that there is fiscal conservatism that we have seen in terms of, so just let me just retrace us a little bit. So I think if you see that what has really helped banks again and why banks are doing well, I think 2 factors have worked very well. One is in terms of the stance of the government, that when COVID came, it was a very calibrated response which was there, right? So the fisc was kept in balance. Similarly, in terms of monetary policy, there was no, again, wild cutting of rates which would then result in disruptive change now. I think what you are looking for is that kind of responsible fiscal management, if that were to continue, I think that's something which would be the best to really look for, because banks are today positioned very well. you don't really require any dramatic action for the banks, again, to look at doing much better. What's important is that the path of prudence that the government has chosen through very difficult times, we stick to that. And I think that probably should be the best story as far as banks are concerned.
Mr. Dave?
Yeah, no, I think, see, I don't think banking industry figures very prominently in budgetary discussions. It's a mature industry. It also doesn't ask for too many things, unlike a lot of other industries, excise cut, excise hike, import duty. There's very little, the policies around how interest rates are to be taxed, interest income is to be taxed, bank. It's a very stable thing. So the specific thing I think would be, it's going to be second order, not first order. If you continue to prioritize capital expenditure over revenue expenditure, that the government does the capital expenditure, that crowds in some investments, that creates business for MSMEs. A lot of that goes second order, third, contractors and all that. That does create then lending opportunities for banks to businesses who ultimately are supplying to the government directly or indirectly, and therefore cash flows eventually do come back. If you continue to do the right things, as Mr. Chadha mentions on the fiscal side, naturally it allows the private sector to do its thing, creates employment, creates wage inflation a little bit, which then continues to support the retail, what we spoke about earlier. So I don't think we have any direct level expectations, but I just think as long as we don't do anything dramatic, don't come in the way of what's happening in the economy, which is what this government has only done. If you see last 2-3 budgets, I don't think there's any headline. The headline is that there's continuity, and that continuity allows everybody to plan and then invest, and that's what I would expect to be the case this time as well.
Mr. Prashant Kumar?
No, I think like what Sanjeev and Mr. Dave has stated, bankers, they don't have the very, very direct relationship. But I think as long as budget or the policies continue to be on the similar lines, which is focused on the growth, I think that can be very always helpful in terms of the credit growth for the banks. And also if there is a economic development, and which always they don't come only through budget. But I think the continued policy of the government, the way it is happening over a period of time, in terms of support for the industry, the support for the innovation, the support for the entrepreneurship, and that ease of doing business, I think that always helps. So I think if the government and the entire system continue to move in the similar direction, and should not worry so much on the inflation, I think the growth is something which should not be sacrificed at this point.
Thank you, everybody. I'm just going to throw this open to the floor. Please introduce yourself, your name and your organization, and please say who you want to reply to your question.
Hi, good evening, folks. My name is Ajay. I represent Hero, the group which makes cycles, motorcycles, and a lot of other things as well. There's a lot of discussion happening about India at 100, India at 2047. And as we see in last few years, few decades, rather last few recent years, banking industry has been undergoing significant trends in terms of consolidation. We've had HDFC Bank, SBI, everything consolidating. Now similar, and other trend which is coming up is that foreign banks, they are one by one, they are pushing out, right? They have not been able to crack the India code. So, we have the industry leaders sitting here. What do you think would be the banking in next 2 or 3, 10, 20, 30 years? How will it look like? I mean, would we still have the branches existing? Because we look at millennials or the Gen Zs. I mean, we see our kids. I don't think so any of them would be visiting branches. Would we still have bank branches in next 20, 25 years? Or with the new age fintech players coming in, the kids have access to all those. Would banks still have that kind of monopoly, or not monopoly, I should say, the kind of majority that they have on the financial system? Would they still have it, or would it go away? I mean, considering that the regulatory mechanism is impartial to everybody. So these are the 2-3 things I wanted to have.
Anybody in specific you'd like to reply to your question?
So we have each of these 3. We have got the head of a foreign bank.
Let me take the foreign bank.
Mr. Dave,
let me take the foreign bank part, and I'll
listen to the bit.
No, just on the foreign bank part, because I think it is a fact that domestic banks are very, very high quality. Okay, I think it's a And that has made life, we can blame regulator, we can blame anything, but the reality is in the same marketplace, players have become created and built huge, very valuable, great brands, great institutions that do great job for the customer. So to the extent that I think, this happens in every industry. It's just that, in every industry, the strong muscle out there, not so good. So to the extent that some of my, my foreign bank industry, let's call it, couldn't cope with it, that's just a reality. But at the same time, I think the same international banks, and I represent one, I think is clearly seeing what India, as you mentioned, of the next 25 years can be, should be, hopefully will be also. We will go from $2,500 per capita income over the next 25 years, could be easily $10,000. And at that level, the level of consumption that will happen in India, the level of investment that will happen in India, the number of airports we will need, everything that we will need will be not a multiplier. It will be much, much more. So the same banks that possibly have not managed to do a good job, I hope will do a good job, and hopefully we will also serve the Indian economy, along with our colleagues and partners in the public sector banking space as well as the private sector banking space. But for the other part, I'll leave it to...
yeah, but his question about, the Gen Z and branch,
yeah, so that's one thing.
No, I think the answer lies in your question. Okay, the people may not like to visit the bank branch, but I think you would not like to place your deposit with an institution where there is no branch. I think lot of comfort always a customer get when you have a physical presence, if you know there is a bank which is available. I think across the globe, the experiment in terms of a pure digital without a physical bank branch has not been successful in a very, very developed economies also. It's only the way the branches function, the format of the branches would make a huge change in the next 30, 40 years. If earlier, maybe 15 years back, there has to be a large branch, 100 people doing everything in a branch. Now it would become a simple outlet, a small, smart outfit which is available. If there is a need, the customer can be served. Otherwise, customers can do their transaction, do the banking needs anytime, anywhere kind of. So I think the format of the branches would change, but I think the physical presence of a bank is very, very important in terms of giving that confidence and trust to the customer.
So, the branch as a competitive advantage would not be there. So, for example, SBI having largest branches, would be equivalent to HSBC, which has got least number of branches if they are technically savvy. It could happen that way as well.
No, I think that's why always like if you want to go deep into the Indian economy, I think the presence of branches is very, very important. Without that kind of branch network, I think the expectation in terms of going very granular and going for an inclusive growth would be difficult.
So let me just try to answer that. So I think it really depends upon where you are. Now let's take a bank like BOB, which is, you might say, among the larger banks, not the largest. So we have over the last 3 or 4 years, partly of course because of the fact there was a merger, our branch network has come down by about 15%, right? And this is largely retail. But our retail loans have gone up by 70%. So the one-to-one correlation between a branch network and the business that you can do, to my mind, has broken irretrievably. That's never going to come back. And why that has been possible is because of what we saw particularly during the pandemic, because of the mobile phone. To my mind and how we see it again, the mobile phone is the centerpiece. And now you have to go about designing the rest of the bank around the mobile phone, right? Even today, for us, 5 times as many customers use Bob World as compared to those who come to our 8,000 branches. This proportion is going to keep on getting moved in favor of digital every day. So I think that's a reality we cannot really move away from. But equally, as Mr. Prashant Kumar said, the centrality of branches in terms of physical presence, reassurance, and also meeting customer requirements in terms of problem solving. What cannot be done through a digital interface, that will always remain. But if you have a certain size of branch network, I don't believe you will be adding to it proportionately as your business grows as you move forward. The second point I think which you said was very interesting in terms of the structure of the Indian banking industry. What is it likely to look like, right? So I think that is a very, very fundamental question, because to my mind, the competitive landscape in India is currently challenged. There are not enough banks really to really challenge each other to actually become better, which is why some of the fallout is actually very positive. You have banks which enjoy the highest price to book value in the world. If it were a very competitive market, it could not have happened. And the reason for that partly is that public sector banks, which are 60% of the market, are not as efficient in offering competition. There may be segments of that 60% which are, but that does not apply to the entire 60%. So I think if we have to make the market more competitive and make life a little more difficult to Mr. Dave as compared to it has been in the past, I think there's enormous scope for public sector banks to actually become much more competitive. Today, in terms of credit, 60% is the market share, but in terms of incremental loans you put out every year, it is less than half of that. So I think there's a long way to go for that.
Yes, please.
My name is Sanjay Chaudhary. I'm a private equity investor. Question is, for last 25 years, I think since this private sector banks came in, I think 30 years or 25 years, we've had this share of private banks getting increasing and share of public sector banks decreasing. So to your point, Mr. Chadda, do you see that reversing in going forward? Do you see public sector banks really turning the tables on their private sector and kind of clawing back that share which they have ceded in last 20-25 years?
So I think it is possible, but there is no inevitability to it. I have worked for two organizations, SBI, Mr. Prashant Kumar also has worked there for a long time. SBI has not lost market share, I think, over the last 7, 8, 10 years. Right? If I look at BOB, again, over the last few years, we have actually gained market share. But it requires actually to do a few things very well. And there are two key components to that, to my mind. One is technology and the other is human resources. SBI has been investing in technology for a long, long time. I remember this was 2011, I was ES to the chairman. That's when we actually first started doing a data warehouse 10 years back. So what today SBI has been able to achieve in terms of technology is based upon foundations that were laid a long, long time back. Similarly, again, for BOB, we were very fortunate that we actually had a person who came from Citibank, who did a lot of good things, and that we have been able to build upon. So in terms of human resource talent, we can say we probably have as good a talent pool as any private sector bank, right? In terms of technology, again, we are very well placed. So it's going to be a long grind. It is something which is also an imperative. If that does not happen, then in terms of Indian banking system supporting the Indian economy, in terms of the competitive landscape really being the way it should be, there will be issues. But I think the progress that we have seen over the last few years, that would give us some room for optimism, but we need to build upon that. I think the government made some very, very good reforms over the last few years, right? There was, in terms of appointment of CEOs and whole-time directors, the BBB came in. Now again the government has proposed that there will be a 5-year term for CEOs extended by another 5 years. The government pushed banks to go and get CROs from the market, but now the time has come where the baton must be passed on from the government to the boards of the bank, who must now rise to meet the competition which is there.
Hi.
The one with the mic, this gentleman here.
Hi.
After that, you please, huh?
This is Manish Yadav. I'm a banker and been with ASK. We are the asset managers. Can you hear me now?
Organization?
Manish Yadav. I'm a banker by profession and with ASK, the asset managers. So my question is, being a banker, I mean, we've seen a change across foreign banks, then came the time of Indian banks, then we saw technology shifting in and all the banks trying to shift in. And with the convenience of neo-banking, digital banking, you don't need physical banks. And to the question, what the gentleman asked from Hero, that 20 years hence, I mean, no, you don't need a physical bank. So what happens today? It's all about app, it's all about neo-banking. Where's the value and where do you see banking shifting there? And especially the large PSU setup. I mean, obviously we've seen Bank of Baroda and SBI changing completely, but a long way forward. So where do you see that happening, the neo-banking and the technology taking place?
Okay. So I think we always say that, look, India lives in the 19th, 20th and 21st centuries simultaneously. and so does our client base. So I don't think there'll be a single answer to that. Even today, as we speak, in terms of the network strategy, there are three elements for us. One is the branches, right, which again look at the mainstream requirement of our customers. The second is digital that we spoke about. But equally, the third is the business correspondence. Over the last 4 years or 5 years, even as we have made some progress on digital, the progress that we have made in reaching out to our Jan Dhan customers is even more remarkable. Our number of BCs today is 2 times that what was 3 years back. So a proportion of BCs to branches was 2:1 about 3 years back. Today it is 5:1, right? So I think we will have to accept that our customers are not an undifferentiated whole, that they have different requirements, that something called a digital divide does exist, and we must make sure that we help our customers cross that.
Hi sir, good evening. Ashlesh here from Kotak Securities. I have one specific question to something that you alluded to earlier, which Sanjeev sir alluded to earlier. You indicated that credit demand is now gradually shifting back to the rupee market. So should we expect the share of foreign loans, which has been going up over the past few quarters for some of the banks, to start trending downwards? Should we see the growth in the international book to start trending downwards?
Sorry, we couldn't hear your question. Can you just repeat your question slowly and loudly?
Sure. So Sanjeev sir indicated that we had seen the international credit demand going up over the past few quarters, but that seems to be trending, reversing now. So should we expect the share of foreign loans to now start declining going forward?
So I think, and this is in the context of BOB because it was a bit of an outlier. So in the last quarter, YOY, our international loans grew by 41%. And many analysts ask us the question, look, you sure what you're doing? There's a world in crisis, right? Banks again, they are in trouble. India is booming, and your international loans are growing by 41%, which is 2 times the rate of your domestic loans. So are you sure you know what you're doing? So I think the answer to that was really in the first question that Rajneesh asked. There was a challenge in the last 2 years in terms of corporate demand in India. Because of the fact that demand was not robust, the margins were very depressed. Banks were competing for a very small pie. Therefore, what we found was that the international market, we were able to get a better risk-adjusted return as compared to the Indian corporate market. And given the fact that 50% of our portfolio is corporate, you needed to grow corporate also. So that was a idiosyncratic one-off event. I would believe we should be normalizing. And as demand in India picks up, I would believe that the better opportunities will continue to be available in India.
Perfect. Thank you, sir.
Any other questions? Okay. So if there are no other questions, let me call this session to a close. Please join me in thanking all our esteemed panelists for a wonderful time. Thank you, Mr. Chadda, thank you, Mr. Dave, and thank you, Mr. Kumar, for taking time out. Truly brilliant. Thank you very much.
Thank you very much to all of our speakers. I'm going to request you to please come together for a group photograph. If I could request all of you to please do so. And ladies and gentlemen, while with that, we call it a wrap. We'd like to thank you all for being a phenomenal audience, most importantly. We'd also like to thank our associate partners, Union Bank of India, ThoughtWorks, and Airtel Payments Bank. And ladies and gentlemen, looks like we managed to raise the bar of the conversation, so let's hit the bar and let's head for dinner. That's the plan. Please enjoy the conversations, and thank you for being part of the 15th edition of the Mint Annual Banking Conclave. Thank you. Have a great evening ahead.